I think there's a very big question mark over the whole AI valuation space. And at the moment in the US, I would argue it is priced for perfection. So any step back from that idea that AI is going to revolutionise the world could see once again a very big move downward in US shares.
Michael McCarthy, welcome to The Business.
Thanks, David. Great to be here.
Well, Michael, it seems every day we're getting conflicting info from the US and Iran about how well their peace negotiations are going. So how confident are you that a deal is close, given that directly impacts your investment decisions?
David, we've been told that a deal was imminent so many times that I'm not going to believe it until we actually see the deal. The reality is this is a very tough negotiation because the sides are so far apart on what it is that each are seeking to achieve. And that means it could take a very long time to get resolution in the Middle East.
And on that front, the ASX 200 is down something like 6% in the last 3 months since the US and Israel attacked Iran. But over in the US and parts of Asia, those markets keep hitting record high after record high. So I'm wondering, why do you think our market is underperforming?
It has a lot to do with the composition of the Australian share market. We're a smaller economy. We represent around 2% of the world's economy. And for that reason, our economy is less balanced. We tend to go where we're best. Now in Australia, that means banking and finance, and it means resource-based businesses. That's where our real strengths are, and they make up about 2/3 of our share market when we measure it by value. So that fact means that when those sectors are running hot, or when international investors are looking for domestic exposures, that is home businesses, Australia is favoured. But when the whole world and investors everywhere are seeking high growth opportunities, Australia misses out because we simply don't have as many stocks, particularly in those glamorous technology sectors.
Yeah, so do you think it has much to do with the fact that we're seeing tech and AI stocks surge in, say, the US and parts of Asia, and we don't really have much of a high-flying tech sector, and the fact that we've had 3 interest rate hikes so far from the Reserve Bank while rates haven't moved in those countries?
That's part of it. I don't know that the interest rate story is as strong as it once was when we were in a much lower interest rate environment. The reality is interest rates are headed higher everywhere around the globe, but some markets haven't yet reflected that. And in particular in the US, where we've seen the pricing in interest rate markets go from predicting 2 interest rate cuts in the US to 0, we haven't seen that reflected in share markets yet. And that is one of the dangers to the share market. There'll be a sudden dawning, a realisation amongst US investors that interest rates are not only not going down, they could be going up. And that might spark a corrective move in US shares.
And Michael, the hot trade, it seems, these days around the world is AI and tech. So those kind of stocks seem to be surging day after day, regardless of whether there's a war happening in the Middle East or not. But they can't all be winners. Surely it's not possible. So do you think there's a real risk people who've ploughed a lot of money into the AI trade might get burnt, especially given how expensive their valuations are?
Absolutely. There's a lot of very real risks facing US shares in particular, and largely because the gains in the US have been so spectacular. We're talking about very large companies worth tens or even hundreds of billions of dollars doubling in share price. Now that sort of value creation needs to be backed up by real profits. And at this stage in the AI space, there are question marks about the reality of those profits. Because while people are investing in chips and investing in making product, we're yet to see how the end customers will pay extra and generate all these profits that are being predicted. So I think there's a very big question mark over the whole AI valuation space. And at the moment in the US, I would argue it is priced for perfection. So any step back from that idea that AI is going to revolutionise the world could see, once again, a very big move downward in US shares.
So Michael, our share market here is currently underperforming compared to other global markets, but how do you think the ASX will perform for the rest of the year?
Well, there's something developing right now that might actually see that underperformance in Australia turn around, because we're not the only ones getting nervous about AI and technology valuations. A lot of investors clearly are, and we can see that in the market action. Investors are spreading out across the market. They're moving away from those very high valuations in technology and AI exposed stocks, and they're buying smaller cap stocks. So we're seeing the Russell 2000 index, a measure of small companies in the US, rising more strongly than the broader market. And we're also seeing a move into what's called the halo trade. Now, halo stands for heavy assets, low obsolescence, which is a very mouthy way of saying big stocks with lots of machinery. We're talking about mining stocks, global miners like Rio and BHP. We're talking about infrastructure stocks like Transurban, the owner of all those motorways. We're talking about things that take time to build, are real physical assets, produce real income regularly, and are not likely to be disrupted by AI. So a lot of investors now are looking for characteristics to help either diversify their portfolios or redeploy their funds away from the very high risk in the technology sector towards more steady, reliable, income-based businesses.
All right, this halo trade, we'll look out for it for the rest of the year. Now I've got one last question. So let's talk about the federal budget, in particular changes to the capital gains tax regime, which have been quite controversial. So given the announced changes, how do you think it'll affect the way you invest and the broader share market here?
Well, it's very clear now that capital gains are not the attractive proposition that they once were, and taxing them at the same level as income when it takes a lot more risk to produce that income means that investors are likely to react rationally. That is, they're likely to spend more in the here and now rather than save, and they're likely to move towards investments that will produce income rather than growth. And so this global trend that's going on with investors nervous about growth outlooks and moving into income stocks is likely to be accelerated in Australia by the changes to the tax treatment of capital gains. In other words, Australian investors are going to be looking for higher dividend stocks, and especially those that pay franking credits, because that's one of the few tax advantages left to individual investors.
Well, Michael McCarthy, thank you very much for your insights.
Thanks, David.